Hello, welcome everyone. Yeah, today kind of a choppy, volatile day in markets, and we'll just do a quick review. I haven't. The mini Dow is a product that we have seen through the course of this year at times be less noisy. In other words, less chop and slop, false signals, and intraday volatility. We noticed this in the beginning of January, and that's why we switched from an E-mini model actively into the mini Dow. And so for the person algo optimizer clients, we had just an incredible run in February. And of course, as everyone knows, volatility 500, 600, 800 point days. With the S&Ps, by the way, in contrast, and I know a lot of you are E-mini S&P traders, we had something at one point, a 60 points. That's 240 ticks, 60 full points movement on a 10-day average true range, which means over the average of 10 days, the S&Ps back in February were doing 60 handles. That compares to 7 to 9 in just a few months ago back in October, where we'd wake up and the market didn't move at all. We saw the bulk of market movements from the European session. We would be up or down four points. So what does that mean? Well, it means that the mini Dow was giving some better fluctuations and better trade signals. And this has kind of continued a little bit on and off for this time period. Now today, this is a system model that starts to trade at a certain time period. We had two different models. One started a little bit early for the year to catch the European session, which would be beginning at around 3 a.m., but we kind of changed and altered that due to the structure of how the markets were moving. We go through periods where markets might start to see activity in years past where it was European session, U.S. session, nothing. But now, because of maybe the developments of what's happening in the domestic fiscal arena, as well as domestic monetary policy and earnings, of course, here, we're getting a lot more movement and anticipation of trades happening for U.S. session, and that's where the Dow comes in. So this, as you can see, it had a pretty decent day. We had an equity growth curve coming into the day that made money. Not all trades make, but this is the nature of an algo system. It's designed that if it goes short and nothing happens, get me out. If it gives a buy signal, it reverses. You'll see two little blue lines, one here and one there, and what that means is this actually is designed to scale out and to allow for a trailing stop feature. It went long at here's your long entry at the blue level here. It had made some profits, but it got out with a minimum scratch, small loss, and it went short. So today it's had a few day trades, caught a nice little trend to the downside, caught the upside, got knocked out on a trailing stop function, and then we had a little mishap where, of course, it went short, it got stopped out, and is now long two contracts as we head into the close, or the Globex close, which again is 5 p.m. ET. That's 5 p.m. Eastern Standard Time. So this is the arena that one can utilize the Algo Optimizer. Let's take a look at some other opportunities that were found today, not just in the Algo Optimizer, but what it's indicating for other markets for this week. Let's take a look. Okay, this is our signature product, the VIX, the VXX. When I say signature product, this is one that I've been sharing with you guys for quite some time. And the VXX is what I consider a 5-time derivative product of volatility. I mean, volatility, the VIX, is derived from the valuation of, in essence, spider options, right? And spider options are derived by the value of anticipation of underlying moves in the spider. Spider's value is determined by what? Equity, stocks. So if you think of it that way, it's a derivative, a multi-level derivative product. But it seems to have a couple functions: a contango crush effect to it, as well as an inverse relationship to the equities. So not all the time when equities go down does this product go up. Case in point is this week right now. S&Ps have gone down, and if you notice from last Wednesday's close, we were down Thursday, we were down Friday, and we were down a bit again today on Monday. So what did the VIX do? The VXX did really, in essence, nothing. It's sideways. Now we've gotten chopped a little bit from peak equity. We have slight drawdown, but look at the overall performance in the VXX. I mean, this system is just it's insane. And when I say insane, it's just been we've really tapped into a dynamic product to trade, and the strategies and settings in which to trade it. So the summary, and since the history, and again for this particular year, it's done amazingly well. But we're starting to fall into kind of this contango crush trap, where as stocks go down, this isn't. So what's the case? It's showing a lot of indecision, and that is kind of a definite cautionary flag. So is this market getting ready? Is the stock market getting to crash, or is this a bear flag formation getting ready to drop down into new lows? Now, keep in mind, this product has had 4 reverse splits in its history, and it generally does a 4-for-1 reverse split. When it gets down to around a value of $13, like it did a few months ago, they do a reverse split, and the next thing you know, it's worth around $60. So it just reverts back to $60. And how does that work if you're in a trade? Well, then they do a reverse split on your positions as well. So instead of having maybe 20 contracts, you'd be in a 4-for-1. You can do the math. You'd be in 80 contracts, right? Or reverse split, if you were in 80 contracts, then the next morning you'd wake up and you're only in 20. Higher price, lower position. That's it. So in essence, if this is destined to go down when stocks go up, what is the makeup of the pattern here? You've got a trend, a consolidation. Well, until we break out, maybe we reverse the trend and go up, or we can chop around a little bit more. But either way, if we do break below that 40 handle, it should give us a measured objective in the VIX or the VXX back down into the mid to lower 30s. So that's just one thing that I would say that we will be focused on in this particular week. We've already had earnings on Google. Google beat the top line. They beat the bottom line. The stock rallied up to around, 1,015 in an after-hour session, went all the way back down to 11:15, and after hours back down to 1063. So this has been happening in this earnings season, where we're seeing beats, but market reactions is negative. Last Monday, we had a beat on top and bottom line with Netflix. It rallied, and guess what's happened this week? It's come back down. So the VIX, the VXX, we're not getting a lot of strong indications. Another one of our tools is the advanced decline analysis, and quite frankly, we're not getting a lot of indications there. We're in PPS sell mode in all of the top indices: the Dow, the Qs, the NYSE, the NASDAQ Composite, and the Russell. The breadth of the market, the advanced decline, kind of had an uptick today. We were positive in the S&Ps, 295 versus 202. I don't really get a lot out of this, except for we had a nice trend, a shallow pullback. So is this market getting ready to jump up, or is this getting ready to go down? Again, if the S&Ps go down, the VXX goes up. If the S&Ps rally, then the VXX should go down. Again, that relationship in which I was referencing, the VXX over the last, using its 60-minute chart, and looking at this, that when you compare that daily chart to the VIX, or the 60-minute chart to the VIX, and you compare that to the daily chart to the spiders, we've gone down in the S&Ps, VIX went sideways. So that is another red flag of caution about how do you trade a market that's kind of not showing good intermarket relationships. Volume doesn't look bad. We've got a consecutive series of higher highs and higher lows. The breadth, advanced decline in the S&Ps had a big downturn up and then back down, so it's capable of seeing spikes like this out of the market, and yet it's not going down. One of the things that we've experienced in this market, when it wants to go down, when the S&Ps want to go down, they really go down, don't they? They don't just sit around and stall. So at this point, we are in a precarious situation in the sense that earnings are coming out positive and they're having bad reactions. That's never a good sign. So what's the catalyst that's going to take this higher? This week's worry is, of course, inflation and interest rates. We have a auction in the Treasury notes this week. So maybe we see the yield on the 10 years back off that 3%, which seems to worry the market. Next to that, we have next week the FOMC meeting. People think that the Fed is going to go and move from 3 to 4 rate hikes this year. Well, they need to do at least the second one, and they just raised rates less than 4 weeks ago. So I'm not sure that they're willing to raise rates right now, especially based on the fact that we didn't get higher rate increases around the globe, at least with the European Central Bank, which meets Thursday, and the Bank of England, which already stated they're willing to keep things status quo. So if we see tighter rates here in the U.S. relative to abroad, I mean, this would be a worry of the marketplace, no doubt about it. But obviously, we've got a lot of conflicting stories and conflicting evidence in the marketplace. And in the meantime, what we are seeing, if I go back to looking at our long-term picture of stocks, at least from this perspective of a weekly basis, we're seeing a lot of sectors showing some strength. The broker-dealers rallied. We've got the Dow Jones Internet Trust close to its highs. We have, of course, aerospace defense up. The Russells in a weekly buy mode. I want you to, if you focus in on this chart right here, that's a weekly chart, and I'm looking at this column right here, which points out to weekly radar screen what sectors are strong. So what I'm looking at is all of these sectors are outperforming: metals and mining, industrials, material, aerospace, defense, steel, coal, telecoms, transportation, materials, the small cap Russell, aerospace defense once again, the Bitcoin ETF, the GBTC, Internet Trust, the XBD broker dealers, and TLT is down. That's red, not good. So if long, red, bad. Okay, so I just wanted to kind of, and then the rest of everything else is kind of like chopped and mixed. So to make a really strong determination of where is this market headed, we have more stock sectors showing strength than weakness. Energy's lifting off. That's the XLE. In fact, I'm going to examine this column. Many of you are now familiar with the person's market catcher, a very powerful tool, and it defines the relative strength in different stages of the marketplace, available on the lifetime package with TradeStation with the person indicators, and of course with under John Person's name, that's me, on Thinkorswim. You've got the PPS, person's pivot, and the PMC indicator, and that's the relative strength tool. So if we take a look at this relative strength tool real quick, I mean, let me just point this out and double click on the column, and our strongest sector by value is the energy XOP, oil and gas exploration. And here's what it's reflecting. Even though we had a rally here, it's outperforming the market by leaps and bounds. It's blue, it's above the zero line. However, it's starting to lose its bullish relative strength momentum. What is gaining momentum? Well, these light blues, steel. You can see that the steel sector is SLX is starting that bright blue. So we had a one-day pullback. We'll see if it can accelerate through the upside. And then what's improving is interesting is relative to the S&Ps, the Qs are kind of starting to see improvement, which is really a strange thing. Why do I say that? Here is the reflection of the relative strength. The market's gone up, it's pulled back, and the relative strength is still, even though it's negative, it's below the zero line. See that? It's negative. It's starting to improve a bit. So if that trend continues and we get something like this where it's it's going down, but the price is going down, but the relative strength is outperforming the S&Ps, and all of a sudden you follow by a buy signal, then you could get one more leg to the upside. So this is where we're in a major question mark is this the beginning of a downtrend, or is this a pullback before the market accelerates one more time before the selling may go away to test the upper ends of the boundary? We're not getting a lot of help from the VXX, but the VXX, there's not a lot of hedging and volatility going on right now, folks. So like before, a lot of institutions were going into volatility rather than buying out of the money put options to protect their portfolios. So right now it looks like the market is still posed for a potential rally, and that's the information that I get out of the indicators that we see here. So I hope that I'll update this as the week progresses, and I hope this information finds you well. Thanks again for watching.